The Moo University Consortium of Extension Dairy Specialists in Iowa, Nebraska, Minnesota, plus North and South Dakota, along with the state dairy commodity groups, hosts this series to provide information on emerging topics important for the dairy industry and agriculture in general. We purposely seek out presenters who are leading the national conversation in their topic areas. The webinars are provided free of charge because of donations by the gold, silver, and bronze sponsors listed on the screen. Today's webinar will be archived for viewing again on the I-29 Moo University website, plus on each Extension Dairy Team website, the Center for Ag Law and Taxation website, and the Four-State Dairy Nutrition Conference website. Each participant will receive notification when it is available, plus we will make the announcement through the National Ag Media. Today's presenters are Attorney Donald Swanson with Coley Jensen Law Firm in Omaha, Nebraska, and Christine Teagan, Director of the Center of Ag Law and Taxation at Iowa State University. Christine, the microphone is yours.
All right, thank you, Fred, and thanks to all of you for joining us. We're actually going to start with Don, and he's going to walk you through some of his expertise that he has to share with you just from his many years of practice in this area, and I'm very excited to hear about it. I did want to let you know that if you're on this webinar, you are able to ask questions by typing your question into the question box, and we will be able to answer those questions as they come in. And so we may answer them throughout the presentation, or we may save some of them toward the end, but there will be an opportunity to ask questions at the end of the webinar as well. So we're really glad you're here. I'm going to transfer control of the screen over to Don. Don, do you have your slides up?
I believe so. You see them?
Yes, now we do. So Don's going to take it from here. Thank you, Don.
Well, thank you. It's a pleasure to be here. The topic is financial impairment on the farm. What's a farmer to do now? Let's start with a hypothetical. Imagine a farmer of any stripe: grain, hogs, cattle, dairy, chickens, you name it. The farmer is in financial distress and has been for several years. The banker wants out and is threatening legal action. So the question is, what's the farmer to do now? The answer can be difficult and it can be complicated, but I'll try to offer some suggestions in our time today on an approach the farmer might take. These suggestions are based on decades of experience. I'm an old farm kid, a former state FFA president and American farmer degree. I started practicing bankruptcy law in 1980 and learned how to practice in the heat of the 1980s farm crisis, representing all sides. I filed more than 40 Chapter 12s for farmers. Nearly all have been successful. And I have represented hundreds of family businesses in financial stress. So here are some thoughts on what's the farmer to do now. Take a look at the slide here. I'll just pause for a moment. It's time to find a solution that the farmer will pursue. Kicking the can down the road is what people in financial stress do. Payable times get longer and longer. Requests for extensions become frequent, and excuses for non-payment become artful. But when the bank is applying pressure, the time has arrived to find a solution for kicking the can to stop. The search for a solution must be in earnest and it must be successful. That's because time and opportunity for a solution are growing short. The solution might involve bankruptcy or the threat of bankruptcy. Maybe the solution is a reorganization, maybe it's a liquidation, or maybe it's a combination of the two. But whatever the solution might be, it must be something the farmer wants to do and is committed to doing. It is never good enough to do something that's being forced upon the farmer, that the farmer doesn't really want to do, or that the farmer resents being forced to do. It must be the farmer's strategy. Attorneys can suggest strategies, can recommend a course of action, but that's all the attorneys can do. In the end, it must be the farmer's strategy that's being pursued, or it will never work. Here's a hard knocks example. Farmer has 7 parcels of land plus a homestead. 3 parcels are mortgaged to one bank, and the homestead is included as additional collateral. An attorney recommends a solution that farmer 1, sell the 3 parcels to make the homestead free and clear, and then reorganize around the remaining 4 parcels. Farmer doesn't really like this strategy, but feels pressured into it by the attorney. The attorney starts down this path, but when push comes to shove, farmer balks at selling the land. Now, the bankers are really irritated. What they perceive is that the farmer has, once again in their minds, failed to follow through, failed to do what was promised. As a result, bank relationships with farmer deteriorate quickly and perhaps irreparably, making prospects for an agreed solution nearly impossible. The problem in this example is that farmer never truly bought into the lawyer's strategy. They found a solution, the attorney thought, but farmer never truly bought in, and so in the end, the strategy backfired because the farmer didn't really want to do it. The result, farmer is now in a more precarious position with the bankers than ever before. Take a look at the next slide. Attack the problem as early as possible. I hate it when a farmer calls as a potential client armed with the fact that a replevin hearing is scheduled for Thursday. That's too late. Here's why. The strategy then becomes, by default, a fire, ready, aim bankruptcy filing. It's an emergency filing without any planning or strategy or advanced tactics behind it. And that's a terrible way to handle something this significant and this important. Farmers need to learn a lesson from bankruptcy cases like General Motors. That car maker and its lawyers and financial advisors spent many, many months developing a strategy and planning for their bankruptcy filing. They spent time, for example, looking at the Camaro sales trend lines, its cost of production, whether it is still a sexy sports car, and whether they should continue producing Camaros. They spent time evaluating the Denali and deciding whether to expand or retract their SUV and truck offerings. They spent time deciding whether Buick and Cadillac have a viable future and whether younger people will buy these brands. And they spent time arranging financing for operations that will take effect once bankruptcy is filed. So then, upon their bankruptcy filing, they begin implementing their strategy and walking step by step through the tactics they had mapped out. That is what farmers in financial stress need to do. But they rarely do it. Fire, ready, aim is the usual approach. So, as soon as the bank begins talking about getting out or threatening legal action, the farmer needs to begin talking at once with an experienced lawyer about what to do now. Anything that is started later is simply too late. Take a look at the next slide. When finances get tough, it's time for transparency with the bank. It's time for full disclosure, and it's time for listening to what the bankers are really thinking and what they really want. Usually, when the primary creditor wants out, there are problems. Financial statements are sloppy. Some collateral proceeds did not get to the bank. Cash flows are unreliable, and losses are mounting up. When such things happen, the bank knows it. They may not grasp all the details, but they sense that they do not have the whole story. And what that leads to is imagining the worst, that they are being lied to, that assets are being hidden, that sale proceeds are being siphoned off. So when the bank starts insisting on getting out, the time for such things is over. It's time to come clean. It's time to communicate directly with the bank. It's time to talk candidly about the problems that exist. And it's time to ask the bank for its views on what should happen next. Candid and accurate discussions will go a long way toward restoring trust and toward getting to a solution. And I'm not talking about discussions between the bank and farmer's attorney. I'm talking about the farmer walking into the bank, sitting down with the banker, and saying something like this. Well, things aren't going so well, as you know. Let's go inspect your collateral together, and I'll answer any questions you may have. And I'd like to hear what you think I should do next. Now, I know that's not what farmers want to hear. And I know that such an approach takes humility and can be unpalatable, but it's the only way to find a solution. And that is particularly true when the farmer is not eligible for Chapter 12. Let's go to the next slide. Take a moment to look at it. So when finances get tough, it's time for solid financial data and realistic projections. Garbage in, garbage out on financial data does not work in bankruptcy, period. Historical financial data must be accurate and reliable, and projections must be based on sound historical data and realistic assumptions. Bankruptcy judges hate financial data and projections that are unreliable. That's because it prevents them from doing their job well. Farmer says, "It's all right here," pointing to the head. That is not an acceptable answer to questions about where reliable data can be found. I remember a large farm bankruptcy back in the early 90s where the farmer said just that. I remember the attorneys and bankruptcy judge scoffing at that answer back then. I was a rookie attorney at the time. And that farmer did not survive very long at all, as I recall, in the bankruptcy. So once a bankruptcy is filed, needs for reliable historical data arise immediately. That data is needed for operating expense projections within the bankruptcy, and later it's essential for concluding the case, for getting a bankruptcy plan confirmed. In other words, reliable data is essential throughout a bankruptcy case from its beginning to its end. Here's an illustration of how it works in a plan confirmation context. Farmer provides historical financial data and projections to prove that future payments required by the plan can be made. Creditors object to confirmation, insisting that farmer's data and projections are a pile of crap. If the farmer's accounting team cannot get on the witness stand and explain under oath how that data is accurate and the projections are reasonable, the bankruptcy judge will not confirm the plan. That's how important the farmer's accounting and financial data team proved to be. So, the first thing a farmer must do when tough financial times hit is this: assure that the accounting expertise is on board to handle the accounting demands of a bankruptcy. Accuracy and reliability are absolutely essential, and that's true whether a bankruptcy is filed or not. Let's go to the next slide. Take a moment. The cash flow must work. Whatever the strategy might be that's decided upon, the cash flow must work for that strategy. Otherwise, a different strategy is needed. We cannot expect a strategy to work, for example, when it's based on the assumption that corn prices will reach $8 soon. That is not realistic in today's context. A bankruptcy judge will never buy it, and it's doomed to failure. Or how about this hypothetical? Farmer had a best ever year in 2018. As my 4-year-old granddaughter says, this is pretend. Farmer has best year ever in 2018, so farmer sets up a plan that projects and requires 2018's best year ever result to recur every single year hereafter for 20 years in a row without fail. That is not realistic. Here's a better approach, using a corn farmer as an example. First, figure out what expenses are going to be this year. Then figure out the minimum price of corn required to make that cash flow work based on last year's production numbers. And then ask this question: is that minimum price likely to occur? The conclusion is this: optimism is okay in financial projections, but ridiculousness is not. Let's go to the next slide. Worshipping land is not a virtue. I know I'm speaking heresy here to farmers, but the greatest problem for farmer reorganization is the worship of land. Farmers will not sell land to deal with financial problems. They will not do it, not even if their lives depend on it. And many do not want anyone to even mention it as a possibility. Exceptions do exist, of course, but those are rare. I mentioned a hypothetical earlier about selling 3 parcels of land to free up the homestead exemption and then reorganize around the rest of the land. Assuming hypothetically that such an approach would be successful and that no other strategy would work, do you think the farmer will adopt that strategy? The answer is this, based on my experience: it's highly unlikely. Farmers won't sell land to solve financial problems. They just won't do it. I don't know what to do with that reality. I never have. I've seen farmers lose all their land because they won't sell some of it. And I've seen farmers completely reject strategies with a reasonable chance of success, perhaps the only strategy with any chance of success, because it means parting with some land. What I've done professionally over the years is to accept land worship as a reality, as one of those things I cannot change, and to look for the next best strategy even when one does not exist. This is a problem, and that's all I have to say about that. Next slide. Here's a basic rule for reorganizing in bankruptcy. The debtor must pay the value of assets being retained. Such payments can be accomplished over time, perhaps a 20-year amortization for land and 7 years for equipment. And such payments can be accomplished at a market rate of interest, perhaps prime plus 1 or 2%. A variation on the basic rule is this: farmer does not need to pay the value of exempt assets that are being retained. Iowa exempts, for example, the farmer's entire homestead. The value of the homestead can be very significant. So, in crafting a bankruptcy plan, the homestead can be retained without providing any payment to any creditor on account of its value. There are exceptions, of course. One exception is this: if farmer mortgaged the homestead to a creditor, the value of the homestead becomes a part of what must be paid to creditors under the plan. Let's go to the next slide, and I want to start by apologizing for all the detail here, and I don't want people to get lost in the detail because it's here for some illustration purposes. But take a moment. Here is a detailed illustration of how the basic rule works. Assume that corn farmer has farmland worth $2 million. and equipment worth $1 million. It's February. All harvested crops have been sold and applied to the bank's loan, with a remaining balance of $4 million to the bank. The current prime rate is 5.5%. So, a bankruptcy plan might provide for annual payments to the bank of $181,000 for the land. That's $2 million at 6.5% over 20 years, and about the same number, $182,000 for equipment. That's $1 million at 6.5% over 7 years, with the remaining $1 million of bank debt being discharged in Chapter 12. Now, at this point, farmers should ask this question: do I really need $1 million worth of equipment? The equipment's short-term amortization creates a money crunch, and selling some high-priced but less than essential equipment, perhaps stuff that's not fully depreciated, might provide some relief from that crunch. So, as a farmer evaluates a strategic option, the basic question is this: are future cash flows sufficient to fund operations plus debt service on values of retained assets under that strategy? If they are, then an attorney has multiple options for crafting a plan of reorganization. But if they are not adequate, there is nothing an attorney can do to implement that strategy. A different strategy is needed. Next slide. Don't do fraudulent transfers. Hypothetical. Farmer owns some inherited land. The land is not mortgaged to anyone. It is free and clear of liens. Farmer has a son and a daughter. Both are adults. Farmer comes up with a plan to keep the inherited land away from creditors. Namely, farmer deeds ownership of that land to son and daughter. 6 months later, farmer files bankruptcy. In that bankruptcy, farmer is required, under penalty of perjury, to disclose the transfer. So, at the first meeting of creditors, farmer is asked under oath about the transfer. Why did you make that transfer to your son and daughter? The U.S. trustee asks. For estate planning purposes, the farmer responds, and then adds, and they promised in exchange to take care of me when I'm old. Did you receive anything else in exchange? The U.S. trustee asks. After a thinking pause, the farmer answers, no. Later in the bankruptcy, a creditor representative sues farmer and the son and the daughter to do two things. First, to avoid the transfer of the land to the son and daughter, so that the land can be brought back into the bankruptcy and sold, with sale proceeds going to creditors. And two, to declare that all farmers' debts cannot be discharged in bankruptcy. The final result of the lawsuit is this: farmer, son, and daughter lose all the way around. And it's a fairly easy case for the creditors to win. Moreover, in every subsequent hearing before the court in farmer's bankruptcy, creditor attorneys start with this argument: we already know that farmer has engaged in fraudulent conduct, so, and then they go on. And I can attest that that is a horrible position for the farmer to be in. Back when farmer did that transfer, it seemed like the most obvious and a simple thing to do. So Farmer did it and even figured it was a clever thing to do. But the fallout from that action is terrible and consequences are severe. The Dickens is that Farmer probably could have disclaimed the inheritance in that land, which would pass it on to the son and daughter without incurring any of the fraudulent transfer consequences. So the point for a farmer is this: don't do a fraudulent transfer. Consequences can be severe, and in many cases, similar results could have been achieved by the farmer in perfectly legal ways. But a fraudulent transfer is not worth the grief. Don't do it. Instead, a farmer who wants to transfer assets to family members should talk with an experienced bankruptcy attorney first. That attorney can weigh in on the terms and advisability of such action and can help avoid some of the major pitfalls. Let's go to the next slide. Mediation is a good thing. If a farmer gets notice from a creditor of a mediation opportunity under a state mediation law for farmers, here's my advice. Take that opportunity. Do not let that opportunity pass by. Farm mediation laws for credit problems exist in all the farm states. And the history of such laws is this: when farmers utilize that mediation opportunity, good things can happen. These mediation laws, when utilized, have high rates of success. So ignoring the mediation opportunity and letting it pass is a mistake. I learned this many years ago the hard way. Here's how it happened. A country bank had hired me to file a replevin action against a farmer, and then, when farmer filed bankruptcy, in order to stop that replevin, I'd represent the bank in the bankruptcy case. I dutifully informed the bank of a new law requiring notice of mediation rights to the farmer, that we would provide the required notice and then would deal with whatever response the farmer provides. So we did that. And go figure, the farmer agreed to mediate. The mediation location is several hours away from my office, so I advised the bank to attend the mediation with its local attorney. I gave that advice because I did not expect anything meaningful to come of the mediation. So it wouldn't be worth my travel expense to the mediation, I figured. So that's what I told the bank. A month or so later, I'm sitting in my office on a late afternoon when the phone rings. "We've settled," the voice says on the other end of the line. "What?" I say. "We settled with the farmer," my client says. "We just now concluded the mediation and reached a settlement agreement." At this point, I'm embarrassed because I poo-pooed the mediation. And now they've got it settled. Never again. And they settled it without me. So never again. Since that time, I've become a believer in mediation and its possibilities. And I've seen mediation work successfully many, many times. And so my advice to farmers and their creditors when faced with a mediation opportunity under farm mediation laws is this: do it. So thank you for your attention.
Well, thank you, Don. That was really great, helpful information. I Appreciate you taking the time to share those experiences that you've had from your practice. And remember, if you're in the audience, if you have any questions for Don, feel free to type them into the question box. He's going to stay on the line the whole time. So at the conclusion of the webinar, we'll have more opportunities for questions. And so now I'm going to go ahead and switch gears just a little bit. We get a lot of questions here about things that happen to farmers along the way when financial impairment begins to rear its ugly head. And a couple things that have become clear is that sometimes there's a misunderstanding or a lack of understanding of some of the tax consequences that are associated with assets being sold. And this can be a real problem. And as Don outlined, Chapter 12, Possibilities and Things, Chapter 12 can be, it offers and provides sort of a unique way to deal with some of these tax problems. But before we talk about that, I just want to talk just a little bit about what some of those tax problems are. And many of you are already familiar with these, but I think it bears repeating just because I think sometimes a farmer may think, well, I can get myself out of this mess if I just sell this asset or if I sell these assets, and that can actually really compound the problem. So we're just going to review some of that information. I did want to put my contact information up here, and it's in the slides that I sent you, just because here at the center, we really do like to hear from those of you out there in the field. We love to hear from producers. We like to hear about the things that you're facing so we can provide resources and so that we can also talk to the professionals out there about things that their clients are facing, and it's really helpful for us to hear those stories. So feel free to contact me anytime via email. Also, you can access our website for updates periodically, or a monthly newsletter as well. So here's, as I said, some thorny tax issues I just wanted to talk about. And one of the first ones, one of the most important ones for everybody to really understand how it works, is the recapture trap. So sometimes farmers will think, well, I have a lot of assets, I have a lot of machinery, I have a lot of cows, I have a lot of, assets with value. If I am behind on a loan, maybe I can just sell some of those assets, get the cash, pay off the debt, I'll be good. It'll tide me over a little bit further. But we all have to understand that this can lead to significant tax problems. And that's because in many cases, we like to push the can down the road when it comes to paying tax. So what we'll do is we purchase an asset, and we have many now accelerated ways to depreciate that asset. So maybe we'll just take regular depreciation, or maybe we'll expense the asset using Section 179, which basically allows us to write off the entire cost of the asset in the year I purchase it. Or starting with the new tax law in 2017, we also have the new tool available for 100% bonus depreciation. And that all sounds really great until it comes to the point where we need to sell something. And at that point, we have to pay the piper, because all we've done is accelerated our depreciation. And if we're able to sell that asset for more than the value, more than our adjusted basis, we're going to owe income tax on that sale. And those taxes can definitely be significant. So also, sometimes we may have purchased an asset that exceeds the value of it at the time we sell it, actually exceeds the amount we paid for it. And if that's the case, then we're also going to owe some capital gain tax on the difference between the amount we originally paid for it and the amount we sell it for. Because as you know, depreciation, right, it's intended to allow us to write off the cost of our assets over their useful life. And with these accelerated methods, we often end up writing off the cost and taking a tax benefit for the cost of those assets long before the life of the asset ends. And so under the tax code, the provision that we're dealing with is called Section 1245. And if you sell your asset while it still has value, but you've depreciated it, IRC 1245 steps in to recapture the difference. right? So we recapture the difference between the adjusted basis of the asset and the sales price. And what we have to do for that difference is actually pay ordinary income tax on it. Now, it's not subject to self-employment tax, but otherwise it's subject to your regular ordinary income tax rate. Now remember, marginal rates vary from person to person depending on all of your other income, but typically you might expect to have that ordinary income tax rate be over 20%. So I'm going to walk through just a couple of examples just to show you how that works for different types of assets on the farm. So if we have purchased livestock that we are using for dairy or breeding, and then we end up selling it, that is going to be subject to depreciation recapture, because most of us, if we've purchased livestock for dairy or breeding, we're going to depreciate that asset. We're going to write off the cost of purchasing it. By the time we turn around and sell it, it may be fully depreciated, and all of the gain that we get is going to be recaptured, and we're going to have to pay ordinary income tax on that. Now, if the livestock is sold for more than the original cost, as I said, we're going to have to pay capital gains tax on that difference. So in some cases, we'll have a two-part type of tax that's due on the sale. And so here's an example. Farmer Blue purchased dairy cows for $45,000 and fully depreciated them. At the end of their production cycle, the farmer sold them for $20,400. Because the cows were fully depreciated, Farmer Blue has to pay ordinary income tax on the $20,400 in sales proceeds. And again, depending on the tax bracket of this farmer, the tax liability could significantly reduce the proceeds, right? So you think, oh, well, I've got $20,000, it's going to be available for paying off the debt. In reality, by the time we've paid off our tax, we have much less of a pie to use to apply toward the debt. Also, here's one where we have really significant tax liability. So let's say Farmer Blue built a new single-purpose ag building, a dairy barn, in 2016. And let's say it cost $300,000. And we have, Section 179, like I said, it's up to allowing people to write off $1 million indexed for inflation in the year of purchase, or the year that the asset is placed into service. So in this particular case, we were at a $500,000 level. So Farmer Blue in 2016, when he put the new dairy barn into service, he wrote off the entire cost of it, $300,000. So that was a good deal at the time. He would now like to sell the barn for $400,000, but what's going to happen is he's going to owe ordinary income tax for the $300,000 of Section 179 that he wrote off, because that all has to be recaptured. And then the $100,000 that the barn has gone up in value is going to be taxed at capital gain rates. So again, he's going to have significant tax liability for that sale and will not recognize all of the gain from the sale that he would like to have to be able to pay off the debt. In a machinery example, we have a similar situation. Let's say Farmer Gray purchased a tractor in 2017 for $120,000, fully expensed it under Section 179, very common approach. One of the lessons from these examples is just because a tax provision exists doesn't mean we need to use it, right? So we're seeing a lot of farmers that are choosing, okay, we're not going to elect Section 179. We're going to try to stretch out depreciation because perhaps we're having a year where we realize that we don't need it so much, and that can help avoid some of these traps. In 2019, Farmer Gray, she sells her tractor for $100,000, and as we've talked with the other examples, she's going to have $100,000 of 1245 recapture to pay ordinary income tax on. So she'll have a significant tax bill for that sale. Now, one thing I will point out too, as we're discussing this, is with the new tax law, the Tax Cuts and Jobs Act that was passed in December of 2017, you can't even trade that tractor for a different piece of machinery without incurring the tax hit, because under the new tax law, personal property is no longer eligible for like-kind exchange. So even if she would trade that tractor for something else, she would still owe that $100,000 of 1245 recapture ordinary income tax on that amount. So again, there's really no way to escape that. Now, if she traded it for something, she could then apply Section 179 against the cost of the new item that she purchased to try to offset the ordinary income tax that she would owe for the sale of the old tractor. But again, these are just concepts that we need to keep in mind. So we also have an example of farmland. And so in this example, we're going to say that Jerry is an active farmer. He's materially participating in a farming operation at the time that he decides to sell his farmland. Depending on what you're doing on the land, your tax liability can be different. But in this case, let's say Jerry's a farmer. He has 500 acres of farmland. He inherited it from his grandmother way back in 1980 when it had a fair market value of $500 an acre. So the basis in this property is really low. If he would go to sell it, it's now worth $10,000. He wants to sell it to get out of debt, but the basis is only $250,000. So if he gets that nice sales price of $5 million, he is going to have a lot of gain that he's going to have to pay tax on. Now it's going to be taxed at the capital gain rate, which if you're selling assets that aren't worth that much, the capital gain rate for some things is 0, and then it goes up to 15. And in many cases, for a lot of capital gain, you'll end up only having to pay 15% on it. But because he's selling so much, the majority of this gain is going to be taxed at the highest rate, which is 20%. Now, because he's a farmer, he won't have to worry about the additional 3.8% net investment income tax. And in a state like Iowa, he would, for now, be eligible for a capital gain deduction under state law. But in other cases, other states, you're going to have to worry about state tax liability as well. So in other words, bottom line, you're going to have quite a lot of tax liability that's going to be due if you decide to sell farmland. But the moral of the story is you may have a lot of assets and you may be very thoughtful about thinking, well, I could sell these assets to pay off this debt, but just remember, a lot of people forget that the tax bill that is incurred from the transfer or the sales of those assets is going to take out a big chunk of the assets of the proceeds that are going to be available for paying off debt. So that has to be factored in anytime that we're considering what our possibilities are. And then another question that comes up a lot is, what if the bank just forgives the debt? Well, that may sound great. Like, isn't that just a gift? We don't have to worry about it. And the answer is, well, cancellation of debt income is going to be taxable too in many cases. Now, there's all kinds of complicated rules, but the general rule is cancellation of debt income is taxable to the extent the cancellation makes the debtor solvent. So if the debt cancels debt to the point where the debtor is now solvent, able to continue, that's going to generate a tax bill. And so, one more thing to consider. Now, that's another area where if you proceed with a farm bankruptcy, a Chapter 12, there are exceptions to that. So in other words, debt can be canceled within a farm bankruptcy and you will not be subject to the tax liability. But again, the rules are pretty complicated. So let's look at Chapter 12. Don talked about that. The general rule in bankruptcy, Chapter 7, Chapter 11, the different forms of bankruptcy, is that you don't get to discharge your tax debt. Now that's the general rule. The IRS is going to have a priority claim for taxes that are owed in most cases. And so even though you have many ways that you can discharge debts in bankruptcy, tax debt oftentimes survives. And so this is a really difficult problem if you think about a farmer who might want to sell assets to be able to continue. If you didn't have a way to discharge tax debt, you would not be able to continue, because if you just sold some of your assets, as we just went through all those situations where the sale of assets generates massive tax liability. Basically, you wouldn't wind up with enough to pay off the debt, and it's like a vicious cycle. So back in the 1986 timeframe, when we had the original farm crisis, Congress crafted this Chapter 12 provision, which said, okay, we realize farmers have unique needs. And so Don talked about that. He talked about, Chapter 12 providing special opportunities for farmers. And the one provision I want to talk about just briefly is the fact that Chapter 12 is the only provision of the bankruptcy code that has a special provision for tax relief if you're dealing with the sale of farming assets used in the debtor's farming business. So Chapter 12, if it's handled properly, a farmer can right-size the business, so to speak. They can sell off some assets, and what happens to the IRS claim is that it is looked at as a unsecured claim instead of a priority claim. It's called priority stripping. If it's all handled correctly, Chapter 12 steps in and says, okay, we're going to demote the IRS claim to your taxes, and it's not going to be a priority claim. It's going to be put in the pile of other unsecured debt. And unsecured debt, Don walked through the fact that, yeah, you have to make sure that that your plan allows you to pay off your secured debt, but it doesn't require you to pay off all of your unsecured debt. So unsecured debt can actually be discharged. And so the special Chapter 12 provision, if it's able to apply to a farmer's case, will actually take some of that tax liability that you have from selling assets, put it into that pile of unsecured debt, and allow it to ultimately be discharged. It's a great provision for the right situations that can allow a farmer to actually right-size their farming operation and move forward without being crippled by too much tax debt coming in and saying, well, this plan will never work. So it's a good provision. There are some limitations. Right now, the Chapter 12 is only available to farmers whose debt is below roughly $4.1 million. That's an indexed for inflation amount. There's legislation pending that says, well, so many family farmers have debt in excess of that amount. And so there's legislation pending that would allow Chapter 12 to apply to farmers with debt up to $10 million. Now, you still have to be a family farmer. You have to meet all those provisions, but we'll have to see what happens with that legislation. Right now, if you are a family farmer with debts under the roughly $4.1 million, you may be eligible for Chapter 12. But you have to be able, as Don said, to create a feasible plan, which means you have to be able to show that you can make payments, that you have some income stream available once you've right-sized your operation to be able to make the payments, to get your secured creditors paid in a way that would ultimately give them what they need amortized, over the life of the plan. So the crucial thing I want to get across is this is all very complicated law. And you need to seek experienced counsel before you sell assets, right? So the one thing that I think everybody probably realizes is you don't just try to take matters into your own hands and get a notice from the bank and say, oh boy, I gotta pay this, I'm gonna go sell something, and because you might end up forfeiting your ability to take advantage of some provisions that would be beneficial for you, that would allow you to actually, reorganize the business in a way that would be successful. And so my advice would be, if you're in financial difficulty, if you're having problems, sooner rather than later, seek out an experienced attorney. And I say experienced professional, I mean somebody experienced in farm debt, farm financial distress. There's different issues, right? And Chapter 12 is its own animal. It's totally different. This is not a situation where you just go to somebody that does a lot of bankruptcies. a lot of Chapter 7s, a lot of Chapter 11s, you need someone who's experienced in understanding the unique situations that come with farm bankruptcies, farm debt. Timing is really essential with these different provisions. And so without getting into the details, because we don't have the time at which you sell the assets, before, during, after bankruptcy, outside of bankruptcy, all of that can mean you have a whole different result. So you have to really work with an experienced attorney to figure out what's your best option. Bankruptcy may not be your best option, but the attorney can definitely also help you figure out how you should perhaps sell some assets to right-size your operation. And the rules are really complicated, so you just don't want to get yourself in a situation where you end up with a lot more tax liability than you needed to have. And while we're talking about unexpected liability, I just briefly want to mention something that I've been hearing a lot about from producers and also their tax professionals, and that is when it comes to health care. So many farmers are self-employed. They are really having to pay a lot of money for health care. A lot of them have ended up going on to what's called the marketplace that was made available by the Affordable Care Act to purchase healthcare policies. So they go onto the marketplace, they're asked how much income they have, they put in a particular amount of money, the system spits back a value and says, oh, based on your income, you're eligible for what's called an advanced premium tax credit in the amount of X. And so the farmer says, oh, great, I only have to pay $300 a month for health insurance. That's fabulous. Goes on about his or her way, doesn't think much about it. Well, the thing you need to understand if you buy health insurance on the marketplace is that amount that you put into the system that was your income is kind of locked in there. And you were only eligible for that subsidy, that extra amount, because your income was below 400% of the federal poverty limit. If throughout the year you sell assets and generate some unexpected income that pushes you above 400% of the federal poverty limit, you will have to pay back all of those credits that were paid on your behalf. And there is no kind of discretion that IRS can apply to say, oh, never mind, you don't have to pay that back. And so just a couple of cases we've had that have given unique situations, and we've actually had quite a few cases on this that have just said, nope, no discretion, you have to pay it back. And the liability for these payments can range. I mean, they can be $20,000, $30,000 in some cases. So it's just another reason why, if you're going to sell off assets, make sure that you check with your tax advisor if you have your health insurance on the marketplace. There are ways that the tax advisor can help you to try to keep your income down, perhaps purchasing an IRA or something to sort of offset that hit. Because if you have debt that's canceled and that counts as income, that can put you over the 400%. If you have to sell assets just to pay off a bill, there was a case where the husband had terminal cancer and they sold an old family heirloom just to pay the son's college expense, and the IRS came and collected the advanced premium tax credit and said, nope, there's no discretion, we can't get out of that. So that's just one more thing we've been seeing quite a bit of in terms of unexpected financial hits from the sale of assets, and those quickly was just sort of a summary of some considerations. Don, are you still on? I think we have some questions here.
I am.
All right, here's a question that I think would be good for you to help answer. It says, what kinds of situations may be good for selling assets to pay off debt?
Well, the primary one is if there is no way to make a cash flow work with the current asset load. The big question is there a smaller amount of assets? Keep in mind that you're paying the value of what you're retaining. Is there a smaller amount that will make that work? A second reason, and maybe a primary one, is if, let's say, you have $5 million of assets, so you aren't eligible for Chapter 12 relief, and you want to get into Chapter 12, you might sell some assets for the sole purpose of making sure your debt, total debt, is under the limit. Keep in mind that once you sell, if you got to incur taxes, you got to factor that in as well. But that could, those two situations are primary ones where I see it becomes important.
Thanks, Don. Here's another one. Farmer is facing pressure from the bank. He realizes that he did not get the money from his sold commodity to the bank. Now he doesn't know what to do. He's trying to kind of figure things out. What would be your advice for somebody that maybe wasn't quite open with the bank early on?
So you're talking about there's some collateral, proceeds from collateral that went someplace other than the bank?
That's what it sounds like, right?
Okay.
Like maybe they sold their crop or they sold their livestock that was collateralized and forgot to, or just kind of, yeah.
Used it put it back into the operation rather than, then the check didn't come with the bank's name on it for some reason, and so they used it for something other than what the bank required.
Yes.
Well, you know, those are tough things. Those are the sorts of things that can get a farmer in trouble. And ultimately, the best solution, in my judgment, has always been this, and I alluded to it earlier, and that's prompt transparency. And that usually means coming clean as soon as possible, and then doing everything possible to make it right with the secured creditor. And you know, there are many risks and no easy solution for that, but a farmer with concerns, my suggestion is this: to find an experienced bankruptcy attorney and make a full disclosure to that attorney, and get that attorney's advice before doing anything. But here's one of the problems. When it comes to filing bankruptcy, full disclosure is required under oath and under penalty of perjury. And as I'm working with clients to prepare them for signing bankruptcy schedules and related documents, I'm fond of saying something like this: I've been doing this a long time, have put many clients into bankruptcy, and I'm very proud of the fact that I've only had one client, only one, go to federal prison for lying on these documents. In that particular case, the client farmer had sold livestock in another state, lied about it in the bankruptcy. Once they got caught, things went badly, even though they had plowed the proceeds back into the operation. So anyone with a concern of that nature, my advice, get an experienced attorney, experienced in bankruptcy, make a full disclosure to that attorney, and follow that attorney's advice.
Thanks, Don. Hey, does anybody else have any questions? We still have our panelists here on the line, and we can entertain any questions that come in. And otherwise, I would just like to thank you for being part of this webinar. I appreciate Don joining us. Thank you, Don, for your sharing all of your insights in this important area. Thank you, Fred, for organizing this webinar. And again, thank you all for being on the line. Again, you have my email, my contact information. If there are questions that you didn't get answered during the session, feel free to contact us afterwards, and have a great week. Thanks.